Even if you lack the time or interest to choose individual investments on your own, passive funds can nevertheless help you establish a diversified investment portfolio. They provide an excellent substitute for mutual funds that are actively managed. A passive fund is a type of investment vehicle that makes investment decisions based on the performance of a market index or a specific market segment. In contrast to an active fund, a passive fund's fund manager does not decide which securities the fund will purchase. The market regulator recently published a circular on passive funds that address issues with exchange-traded funds, ETFs, and index funds' operational elements, liquidity, and transparency. These rules took effect from 1st July. Let us answer 5 important things about passive funds. First, what is a passive ELSS scheme? Second, what are the norms for debt ETFs? Third, what about tracking error? Fourth, what is the mandate on disclosing NAVs? And can one execute ETF transactions directly? The Securities and Exchange Board of India, SEBI, has now introduced a passive equity-linked savings schemes (ELSS) category, which will give taxpayers another investment option to avail of tax benefits. According to the circular, the passive ELSS scheme will be based on any index comprising equity shares from the top 250 companies in terms of market capitalization. Beginning 1st July, a fund house will be able to either have an active ELSS scheme or a passive ELSS scheme, but not both. Passive debt funds are now divided into 3 categories: corporate debt funds with exposure to corporate bonds, GSEC funds investing in government securities, and hybrid funds where allocation is a combination of corporate bonds and government securities. Currently, debt funds in the passive category invest only in AAA-rated instruments. The SEBI circular introduces norms for each debt fund category, including portfolio exposure limits to each sector, the issuer, and the group. The application of these provisions should help mitigate concentration risk in debt ETFs or index funds. As per SEBI's circular, passive funds must disclose tracking error and tracking difference in their monthly fact sheets. These metrics indicate how different the performance of the fund is compared to its underlying index, which is an effort to keep investors better informed. The circular specifies limits for tracking error and tracking difference, which passive funds must follow. Because of poor liquidity for ETFs in the secondary market in India, ETF prices could differ widely from the net asset value (NAV) of the fund. The NAV of the fund represents the value of the underlying asset of the ETF. The SEBI circular mandates disclosure of NAV on a continuous basis throughout the day on the stock exchange. While the practice is already in existence, SEBI rules institutionalize it. Checking the NAV can help one avoid making a transaction at a significant premium or discount. Investors can buy or sell units of ETFs only on stock exchanges. But large buy or sell transactions can also be directly placed with the fund house. SEBI now says orders greater than 25 crore rupees alone can be placed for redemption or subscription directly with the asset management company, AMC. This is expected to direct the transactions up to this limit to the exchanges and enhance liquidity in ETF units. Nevertheless, there are few other exceptions specified where ETF transactions can be done directly with the AMC.